Good morning, all my beloved students. Today we are going to discuss some important provisions of income tax. Very important areas we would like to discuss here. It's a very short video. All of you please listen. First important thing that we have to discuss is what is meant by annual accretion and its tax implication. Next one, that is the exact meaning and real picture of transferred balance and the tax implications and idea behind national pension scheme, which is introduced by the central government on 1st April 2016 onwards. Let us see first one, that is annual accretion. We know employees, we are already discussed in our previous slides or previous videos. Employers' contribution to the provident fund of an employee in excess of 12% of salary and interest allowed by the employer on the balance of the provident fund exceeding the prescribed limit, that is 9.5%. You may have some confusions while you are reading these sentences. I will clear here. I will try to clear. Annual accretion means employer contribution to the provident fund on employee. We know that there are three parts as far as a provident fund is concerned. First one, employee contribution, and interest credited on this fund. See, employer contribution to the provident fund of an employee in excess of 12% of salary, that is taxable. Clearly, it's explained our previous classes. I will explain this again and again. Employer contribution to the fund of an employee in excess of 12%. Yesterday I have given an example. Suppose an employer contribute to 13%, and percentage is taxable. Suppose an employer contribute correct 12%, it is exempted. There is not tax. It is purely exempted. Suppose an employer contribute 11%, there is no tax liability. Suppose an employer contribute to 13 or 15%, 3% is taxable. So the excess of amount of 12% of salary is taxable. As in the case of employer contribution, we have discussed the employee contribution is an application of fund, there is no tax liability. Again, one more thing, that is interest rate. Interest rate is taxable in excess of 9.5%. Any interest credited on the annual accretion is taxable when it exceeds 9.5%. Suppose X is an employee working in XY Limited who contribute 1,000 rupees. Employer also contribute the matching amount to the provident fund. 10% interest is credited on his provident fund. What will happen here? If the 1,000 rupees equal to 12% or below to 12%, there is no tax liability on the contribution made by the employer. Even though the interest rate is concerned, here interest is credited 10%, so 0.5% of interest is taxable in the hands of the employee. That's the idea, that's the logic behind the illustration. Clear? Then another one, that is transferred balance. A few students are asking some doubts related to the transferred balance. That's why I have included these slides in our discussion. Transferred balance means when an unorganized provident fund is recognized by the Commissioner of Income Tax, the balance standing to the credit of the employee in the unorganized provident fund is transferred to the recognized fund, and it is called transferred balance. Nothing more. Suppose an employee maintaining unrecognized provident fund. Take an example. Mr. X is maintained a provident fund which is unrecognized up to the date of 1st June 2020. What will happen? He has maintained his fund automatically up to the date of 1st June 2020. On 2nd June 2020, the fund may be recognized by the Commissioner of Income Tax. What will happen here? The status may be automatically changed. On 1st June 2020, status is unrecognized. On 2nd June, it is considered as a recognized provident fund. So on that day, what amount is transferred from unrecognized provident fund to recognized provident fund? Clearly, let us see what amount credited in his account on 1st June 2020 is automatically transferred to the recognized provident fund, or it is carry forwarded to the 2nd June 2020. So this transfer or this balance is technically called as transferred balance. I think all of you have got enough idea about transferred balance. Okay. Then another important new concept, that is NPS. That means National Pension Scheme is applicable for those who join service after 1st January 2004. Before that, we have only one pension scheme, that is a statutory pension scheme. On 1st January 2004, Government of India implemented a new scheme of pension that is called contributory pension scheme. Technically, this scheme is called as National Pension Scheme. As per this scheme, it is mandatory for a person entering the government service on or after January 2004, he should contribute at least 10% of salary every month towards this national pension scheme. Then only he can claim pension after getting retirement. Otherwise, there is no retirement benefit or pension. That is the mechanism. One more important thing, that is employer also make matching contribution towards these NPS every month. This scheme is only applicable in the case of private employee or covered under contributory pension scheme. It is applicable to the whole sector of government. After 1st January 2004 by the central government, and later it was implemented by the state government, government of Kerala also. Now we can see what is the tax implication of implementation of national pension scheme or under contributory pension scheme. Two components we have. First one employee contribution, another one employer contribution. We know employee contribution contribution made by the employer that is included under the header salary. Employer contribution is eligible for deduction under 80 CCD subsection 2 up to 10% of salary also. Then employee contribution, another part of that is employee contribution. We are already discussed at least 10% of salary should contribute towards these funds. So 10% of salary or 1,50,000 whichever is less can be claimed as deduction under section 80 CCD 1 subsection 1. With effect from 1st April 2016, an additional 50,000 is available under section 80 CCD 1B. When pension is received out of fund at the time of retirement, it will be taxable as in the case of statutory pension. Once again, I will discuss all these things once again. That is NPS, two components. Employee contribution, employer contribution. Employee contribution is or can be claimed as deduction. The limit is 10% of salary or 1,50,000 whichever is less under section 80 CCD. With effect from 2016 1st April, additional 50,000 also can be claimed as deduction under section 80 CCD 1B. So the total of deduction can be possible under section 80 CCD 1 and CCD 1B is 10% of salary or 2 lakh whichever is less. Clear? Then employer contribution is eligible for deduction under section 80 CCD 2, that is maximum up to the 10% of salary. Then this contribution can be included under the header salary. So then here we are status that salary. Salary here means, as in the case of we are discussed in our previous videos, we are clearly defined the salary for the purpose of calculating the taxability of recognized provident fund. Here salary means basic salary plus DP, dearness pay, plus DA if it is taken as a part of employment, plus commission on fixed percentage of sales or turnover. Okay, so as in the case of calculation of RPF. So these are all the discussion of today's class. Thank you to all.